So that's 4% of my account, 16 times a quarter of a percent. And then in the end, I'm looking for an outcome. I'm looking for one move that averages out.
Welcome everyone to Sitting Down with Jean-Francois Boucher again. We've done a few videos before together going over his scalping strategy. Today we're sitting down again to go over it again, answer some questions that people have about his strategy and how it all works. And he's going to be really transparent with you guys, sharing all the stuff he's doing as always. Jean-Francois, good to have you here again. Good to catch up with you, and looking forward to see how you can show us some things today.
Sure. Nice to be back. It's the strategy hasn't changed, but the environment has. Approaching the U.S. elections, we're becoming more and more volatile day to day, and so forward testing the strategy is becoming challenging for some, and usual for others. So the box doesn't change. It's the market that we have to keep up to.
I mean, tell me more about this. Is it easier to trade now that you have a lot of volatility? You have price go up and down a lot more. I guess you see more moves intraday, or as a scalper, is it the same or a bit tougher to trade?
It's a little bit tougher, and basically you have to have the stick-to-itness. You have to create the plan and have the ability to stick to it to the very last pip, and then implement the next step. So that could be switching to plan B. It could be booking some losses. It could be ending the day going flat and therefore breaking even somehow. The methodology gives you a lot of discretion, and this volatility lets you test some of those ideas that you have, especially around hedging, where you need the market to be moving to get out of the hedge. And so in a more volatile environment like this, you get to test a lot more of these intricate, plans that you may have. Stuff that you need to be able to see through. It's nice to have it on paper. It's nice to think about it. But once you click the go button, it's bedtime. And so you never see it, and so it's nice to be able to have volatility to see your plans come to fruition or not. And at the same time, for you to have a little bit of stick-to-itness. You have to be able to be committed to your bigger idea. And I think that's where some of the problems with this methodology come in. A lot of the questions I have come from the top-down analysis. And so that would be the second step from walking up to my computer in the morning. The first step being, looking at the calendar and making sure I'm not stepping into the NFP or something like that. Right? So we have to recognize what's dangerous for our expected positions. And then if we can avoid it or step aside and wait and trade the reaction to the news, within 5 minutes, you find yourself at a level that you would expect the market to maybe slow down and, range for a bit. And in that range, you can start to implement your next steps. And so it's not about chasing stuff. It's about planning the next step ahead and waiting for the best place to trigger. So first step first, check the calendar. Second step, we do the top-down analysis. On a day like this here, top-down analysis, at some point we would have walked up to the computer and started measuring from a previous swing. I think this was last week. We had a news event. And so the news event itself created volatility. If we measure just that volatility using the boxes, it delivers 3 to 4 boxes on its own, right? So this current swing was 4 boxes, and then a little bit more, a half a box. We retraced. All this kind of stuff is a way of thinking through one standard deviation at a time. And that's all I'm trying to do. That's all I'm trying to teach the folks to do, right? To think of the probabilities of that next swing. So basically, the current swing ended. It was followed by a retracement, followed by another, extension or a continuation of some kind. right? And by measuring these moves, we can expect or anticipate the probable outcome, right? So it's just keeping things in perspective and lowering our expectation. So once we have your top down and your news, you start to drill down into today's plan. And so that's where the Sherlock Holmes, you start to have a deduction, kind of a detective mind, right? So if this has already taken place, I'm left to do this, and this. Or if the market has moved 60 pips and we know on average it does 90, maybe I'll do 30 while I'm here, right? So I'm just trying to think of what an average is compared to what I'm walking into. How much off the average am I? And what do I have to do to get there? And so it's really just a game of thinking one step ahead of everybody else. Everybody else is trying to catch the current move. I'm trying to measure it to see when it ends.
On a day like this, did you already know your bias would be down, or did you figure this out with the news coming out that was a bit big sell move?
So a lot of what I do ends up being, because of time of day, counter trend to the norm, right? So people here will see lower highs, lower lows. It's a downtrend. And here I show up at 8 o'clock playing the bullish side. And it's because time of day compliant. I expect the day to be near finished. And if you look at a daily candle, there's usually a wick there. And this is where that wick comes in. And so it's usually a time and a location that aligns and I take advantage of. Right? So timing wise, 8 o'clock in the morning, which is 10 o'clock Eastern, I measured the past. I have an expectation for the future, and it's within my game plan. It's within my 36 pips of expectation, right? It's not going to go further than 36, and if it is, I'll deal with it in the moment. And so I have this plan, and I have plan B. And more often than not, I end up executing plan B. Right? And so this is the part that people don't expect, right? The market should do this. And if it doesn't do that, they get upset. And so what we do is we think more in terms of could, right? The market could do this. It could do that. It could do this, and that, and the other. So by using the word could, you're opening the door to a lot of possibilities, and you don't get upset if you get plan D delivered or plan F or whatever it is, right? There's always an alternative to what should happen. And so the people that chase the market are chasing something that should be happening. And usually you end up buying at the very, very top or selling at the very, very, very bottom because what should be happening is just not happening. And so in this elite scalping course, that's kind of what we do, right? We measure the previous moves. It sets up the stage for a high probability next leg, which we take advantage of, right? So it's not really elite or scalping. It's all about probability assessment and positioning, right? But if you really take a broader look, it's sophisticated because we're looking at the x-axis. That's where our edge is. We're using time cycles, time of day. Anything that has a time aspect to it comes into play with our strategy. At the same time, within this elite scalping environment, we learn to not change stuff. We target consistency, right? So we're really looking for small, like you see here, repeatable, achievable goals. And then we aim to stop and be finished for the day, right? So this would be a typical trading session. We showed up on time, we executed the plan, and we finished on time like any other business, and everybody goes home at the end of the day. Right? So that's day trading in a nutshell, and that's kind of what we aim to do. There are opportunities for swings here, but I choose to not take them, right? My focus is consistency over a long time, a long sample size.
Cool. I mean, we'll put a link below for that. We've been running this program together called Elite Scalping, as you mentioned. I think you're running it like super, super well. People are getting really good results from it. So I'll put the link below. People can check it out, make their own mind about it. And I want to know, you often call these boxes like measuring cups. They allow you to see how price move, the average range. Tell me how you use these boxes for these trades that you have on the chart now.
Yeah, so this is the Euro USD. The boxes that you see here measure 9 pips, and they are 60 bars across. And this is not arbitrary. It's not some number I picked out of thin air. It's actually something that we measured from the 5-minute chart. It's when we measure the 5-minute chart and you're using, let's say, MT4, for example, you can put on your zigzag indicator. It will highlight the swings. If you measure the swings, something like this and something like so, you measure a dozen or so of these swings, preferably at your preferred, work time. So I have my 2-hour window that I operate within. So you measure 12 of these, right? So you need to measure the length in pips and in time. So this first move here is 13 bars. So that's 13 5-minute bars. And it measures approximately 8 pips. And so if I measure 12 of these, I tabulate the number of pips and the number of bars, right? And then I have to average these 12 swings. So I'll end up with 2 numbers, an average number of bars and an average number of pips. That's my box. And if you repeat this behavior over and over and over and over and over, the box eventually tightens itself up to a point where it stops changing. And that's your average standard move on a 5-minute chart, right? So these little moves back here are made up of average moves, right? So that's kind of our box right here. And then these average moves, we play within them on the 1-minute scale, right? So on the 1-minute scale, we can then start to appreciate the standard deviation for the smallest that it has to deliver, which is achievable, repeatable, and consistent. Think of it as, any trade out there has to start with 3 pips at least. I just choose to take the first 3 pips and leave everything else behind. Right? So every trade out there being 3 pips or more, what I have here is extremely highly probable. And so I'm winning about 90% of the trades. And the balance that is not a win is an averaged out. Right? So it's not necessarily a 36 pip loss, but it's sometimes an average of multiple trades and therefore less than 36. And so we engineer the way in based on what the market is capable of doing, because it's done so over and over and over all by itself. Now we've measured this. And so now that we know the market can move this much without us, without any kind of news, the market can do this with its eyes closed. This is what we're trying to extract. We're not trying to target the entire box. I just want to target from the box. Right? So it's giving me a ballpark. It's giving me an environment. And then within this environment, I know what to do. So I made the 3 pips within one box. If, for example, the market goes against me, so now I'm in drawdown, the strategy allows for so much of this drawdown. So it's not, oh my God, I'm wrong. Everything's going the wrong way. Instead, it's more like, aha, here's a opportunity to fix a problem. And so it's really a way of thinking things through, right? This should have bounced. Instead of bouncing, it's going through. It's a breakout or breakdown. As such, we have to repair it. And so we teach how to repair bad trades or trades that go the wrong way. And so you're either making 3 pips, 3 pips, 3 pips when things go the way you planned. And if things don't go the way you planned, when things don't go the way you planned, you find a way out. You average your way out. You basically, you use a little bit more money to lessen the pain on the exit. All right. So when things don't necessarily go your way, it's not all bad. It can be less bad by spending a little bit of money and engineering an exit that is not so damaging. Think of it like an insurance company, right? The insurance company does not stop accepting your payments just because you put your car in the ditch. They actually expect you to keep paying, right? So just because you're approaching the 36 pip stop, you are expected to keep winning, keep making 3 pip trades.
A lot of people would call this averaging down, like you would just like add money to a losing trade. Tell me how that's different. I know you have a plan about it and you can have measures, but explain to me how that's different than averaging down.
Yeah, so the averaging down to, so what you're referring to is losers averaging to losers. If that's the approach, then that means the first trade has to have been closed and you booked it as a loss, and now you're trying a second time or a third time. You're using more money to chase that original trade, which is booked. Right? That is no longer work in progress. It's an actual physical loss. What I chose to do is take my 1% for that original trade and break it up. And so I'm averaging in my original 1% the same way that I'm hoping to average it out. Right, so no longer am I chasing a losing trade. I'm adding to a working trade. Right, so it's not booked as a loss. It remains 0.25%, and then it becomes 0.5%, and then becomes 0.75%, and then ultimately, if all push comes to shove, I have the entire 1% at work in one box. And then if things still don't go my way, I'm allowed to repeat this process 3 more times. So ultimately, if everything went wrong, or if that's part of the plan for that day, I'm willing and able and allowed to spend 4% to build a position. Right? So that's layering in a box upon a box upon a box upon a box, 16 clicks. So that's 4% of my account, 16 times 0.25%. And then in the end, I'm looking for an outcome. I'm looking for one move that averages out. Right? So I averaged my way in. Right? I didn't know this was going to go back up. Right? I averaged my way in. These are all open trades. And then ultimately, an average move later, or 2, we start to get paid. Right? It's the standard deviation plus or minus. It's not an accuracy game. Right? People that are thinking trading is a game of accuracy, they're in for a misconception. They're in for a really rude awakening. If you can be in the ballpark and aim for the middle, the meat of the market, you're good enough. What I happen to be doing is showing up on schedule, which happens to present me with the tips of the candles. I don't purposefully chase the top or the bottom. I just happen to be here when we make it. Right? It's time of day. So I happen to participate at the same time every day. But I can see the fear that people have with averaging in. And I think part of that misconception is not knowing the difference between drawdown and a loss, and then putting it all in one basket versus spreading it out 4 or 5 clicks, the same amount, right? So one is kind of a dart hoping to be the bullseye, and the other one is more buying opportunities to be right.
I mean, the other thing is your risk is defined too. Like, you're not going to lose all your account on one trade.
Yeah, so that's the flip side of swing trading, right? If I put my 1% with my 2-to-1 target and I have a, for example, 36 pip stop, I would be looking for a 72 pip goal. The average day on the euro is not even 72 pips. So right away I have to think, okay, I'm in this trade for a couple days. Right? And so the flip side to that is between now and then, I could be making 3 pips, 3 pips, 3 pips, 3 or 4 times. You know, I can collect coins while I can see the steamroller coming my way. Right? I can keep running back and forth across the street while I measure how far away the steamroller is. Right? So it's because we measure the risk before we jump in. And if things go wrong, if things go beyond our control, we know to start peeling out some of the trades. So when people assume I'm going to lose 4%, that's if the market keeps going the opposite direction for 8, 9, 10 boxes. You know, it's extremely rare. I've already watched it go 4 boxes. I've measured this, hopefully in line with a bias. So this is a move with an expected outcome. I'm playing into that move. I know where the drop dead limits are. And so by not allowing to go near there, we tend to come out ahead. It's an averaging game, right? So I'm just teaching the folks to measure the past, understand where we are right now, and what the potential is for the next couple of hours, not the next couple of days, right? Because I can't tell what happens between now and then. The news calendar gets in the way, real life gets in the way, geopolitical stuff gets in the way. And so as a day trader, I have a better consistent outcome if I can judge the next hour or so, and then that's it. And so with that comes the possibility that I have trades stuck open. Right? So I'll trade my couple of hours and I make 3 pips, 3 pips, 3 pips. And the trades that don't close, I end up managing them in a group, targeting break even. And typically I will leave everything as is and rely on the stop loss and the existing target. Other times, if I see myself going into NFP or something, I may book half off. I may book all of them closed and take the losses. Other times, I just leave everything as is. Right? If you look at the big scheme of things, if you take a 30-foot view of the market, go to the daily, go to the weekly, go to the monthly. A lot of these news events are just a bump on the road. We happen to see it from the 1 minute chart, and it looks like an earthquake, but it's really nothing in the big scheme of things, right? So if you can figure out the bigger picture and survive on the 1 minute chart, you're okay. Now, what we're looking for is a price and a time cycle. And the same thing is present on all the markets out there. It could be futures. I look at the futures markets once in a while. I did not trade today, but same idea. I use a 4 minute chart. That's my higher time frame. Right? That's my top down. From the 4 minutes, I look down to a 1 minute, which is 4 times faster. And then I break that down to 4 times faster again, which is 15 seconds. And I find myself trading the 15 seconds chart based on what I see happening from the top down, right? So I'm playing within a 4 minute candle. The same way that I'm doing this over here every morning at 8 o'clock, playing within a 4-hour candle. And it's always the same 2 hours within the 4-hour candle. Right? So a price and time cycle, it's always present. It's always there. But we've been trained to ignore the time and to focus only on the price. So everybody's chasing price, and I'm here to teach people how to chase time instead.
How important is your top down to the results of the day for your trading? Like, could you still pick a wrong top down and still win for the day? Or because I'm guessing you're always going counter trend, or is it sometimes different?
Yeah, so counter trend happens to be about 70% of what I do because of the location. And no, I am the last one third of the day, right? The North American session is the last 8 hours of 24. And so when I come to work, most of the day's action's already been taken care of. And so if I have my top down analysis upside down, it's not going to be a runaway market. Right? It's not going to the moon in the North American session. And if it is, it's a short-lived trip. No, it's not going to keep going and going and going and going. We don't care for the euro in North America, right? We don't have a need for that here. And so if you look at the bankers' close, when the banks in Europe are closing for the day, a lot of times you'll see volatility in North America die off. And so right away, you start to engineer plan B. You start looking for that wick on the daily candle. You start looking for that bounce. And so if you've been stuck, if you've been upside down all morning, you do have that exit, that probable exit that's still coming up. It's not a for sure. It's just a probability, right? So if that probability fails again, so now you're 2 days in, the next day you have 4% at work already, so you have 96% of your account left. You now have a choice to make. Do you choose to put another up to 4%? Or do you just do nothing? Right? Right? So typically I will try to engineer a way out from yesterday. So if I come in today and I still have trades open from yesterday, my job today is to seek breaking even. And so breaking even, BE, is really the secret sauce to this strategy. Right? That's the exit that a swing trader refuses to take. Right? The swing trader has to go to the target, or it has to go to a stop loss. What we're looking to do is either make 3 pips or do anything we can to not go to the stop loss. And therefore, breaking even becomes very appealing. And we spend money to get there, just like an insurance company spends money to lose less. Right? So it's the same psychology, except it takes a little bit of training to think things through from the opposite side. Because if you think about it, I'm training myself to play bounces, and once in a while there will be breakouts. And the breakouts are problematic to this strategy. Right? So if I'm expecting to go into drawdown, and now there's another wave of drawdown, these breakouts in the wrong directions become more and more and more important. I have to deal with them. So this is why breaking even is so critical. Right? It allows me an exit and a fresh reset, a chance to do it all over again. So, but yeah, the being upside down is not as big of a problem as we think, because the target is achievable. And if we can't achieve the target, we can look for break even. We can engineer break even. On a day like today, break even almost impossible, right? The day itself was relentless right here, right? The day itself was relentless and very few pullbacks. On a day like today, you end up carrying your trades into tomorrow, or slowly booking a loss, peeling out, right? I tend to not do that very often. Because I'm forward looking, because what I did today was targeting the next move, I was measuring the current move, not knowing where it ends. And so it's all based on that probability, right? It's ending near here. I measured it. And so once I understand where near ear is, I start to play. I start to layer in. And if it goes beyond an average, now it's costing me money. All right. So it's just knowing where to start and when to start. Have you found yourself being way too early to your trades or way too late? All right. I'm not trying to be picky. I'm just trying to be closer to the move. And that's because I understand what an average move looks like. So this methodology is also applicable to, like I mentioned before, futures. But in the world of futures, it's not the price and time cycle that becomes the issue. It's the risk and the money management. Right? So when you're trading futures, it's a FIFO, first in, first out environment. And so right away, if you put trade number 2 on, it's immediately averaged with trade number 1. You have no choice. And so right away, you're targeting break even. You have no choice. And so you're either perfectly dead on and it goes the right way with your first trade, or you find yourself spending another trade and maybe a third and a fourth. You're trying to limit the number of clicks that you're going to spend. Right? So when you're trading futures, the box becomes more of a patience tool. It forces you to be patient. It forces you to be disciplined and to wait for the precise moment instead of, haphazardly throwing darts at the dartboard. You have 4 of them. I'm going to take a chance. No. There's no chances here. When you're trading futures, those chances are just too expensive. And so you're a little bit more disciplined. And I used a lower time frame. I used a 15 seconds chart, so I don't have to be here all day. I also don't trade futures during the normal business hours. I trade Forex during business hours. Right? So I tend to trade futures in the evening when the markets are slower and the 15 seconds chart doesn't look like Mount Everest.
You've been funded multiple accounts in the past. Now you have a few, I think, 100K account, one that you're live with. Tell me about how that works out trading on a 100K account with this strategy.
Yeah, so same idea. Basically, you have to keep an eye on your sizing, and you have to understand the limitations of the prop firm you're working with. And so, for example, a $100,000 account, they'll give you a $10,000 target, and it says in the fine print there that you cannot lose more than $5,000. So think about it. You're not trading a $100,000 account. You're trading the drawdown limit. Right? So you're in reality trading a $5,000 account. And if you size things properly, you can survive you can grow a $5,000 account, without blowing the limits. Understanding where wrong is. So box 4, there's no going back from box 4, right? It's either a fail or it's a bounce. And in this strategy here, in these prop firms, box 4 is the threat, right? You're trying to not go into box 4. And as a newer operator of this strategy, box 4 is your biggest fear. And so if you're new to this strategy, don't try it with the prop firm just yet, right? You have to test yourself in all environments, right? You have to try this out in the trending market. You have to try this out in the ranging market. You have to try this out, in a range extension. You have to try it in all times of day. You have to just forward test the strategy before you risk your hard-earned money on the prop account, especially the legitimate ones where you get funded live funds, because it will raise the level of anxiety. It's now working for a boss that's looking at your every move. It's a very, very different psychological load that you have to carry. It's not the limits that are the problem. It's typically your ego, the fear of failure. These guys here, this particular outfit, I've been working with them for years, on and off. They also have a YouTube channel and all sorts of other goodies. But they themselves have maybe 200, 250 years of experience if you combine all of them as a group. But yeah, the strategy works. It's a matter of discipline, just like anything else out there. And at the same time, discipline with this method is not rule based, right? It's internal. It's the way you perceive probabilities, right? It's the way you think things through. There's no way you can program this strategy and let some robot take care of it, right? Even if you think you're going to be managing the robot, it's just not like that. There's too much freedom almost, right? So you're learning to show up every day to rein things in, to expect less and to be content with less, right? So instead of chasing that $1 million by the weekend, you expect to have consistent results by the weekend.
I mean, some people it makes sense to go for prop firms instead of risking their own capital too. Like if they have not a lot of capital, it makes sense to go in maybe a smaller account with a prop firm, just kind of test it out, get used to the pressure of trading too. I know we had a guy who got funded in Scalping in 12 days or something. I think that's kind of cool.
Yeah. Oh, that's fantastic. But at the same time, you have to have the skills to take forward to the prop firm, right? When I started trading in early 2000s, the pinnacle, the top of the pyramid was to trade other people's money. And now all of a sudden, that prop business clued in and they brought that forward. Oh, you want to trade our money? You can rent it. Right? But it used to be you had to work your way to trading other people's money. You had to have a track record. You had to have experience. And now you're gaining the experience with their demo accounts. You could do that for free. And so get the experience and then use them as an insurance policy so that you don't risk your money. That's the way I approach it. Right? These $100,000 accounts save my $100,000. And so if I blow up the prop account, if I breach that 5,000 limit, it's only cost me the prop account. I still have that 5,000 in my account, right? It's an insurance policy. It's a mind game. But yeah, at the same time, it keeps the accountant happy.
I mean, we've covered a lot here. I think we went through a lot of different topics. Any other thing you want to cover that you think people will find useful?
No, there's definitely a list of news events that we must avoid, right? This particular strategy focuses on avoidance of risk, not chasing risk. And so we're trying to avoid news. We're trying to avoid geopolitical stuff. Holding trades into a weekend is a big no-no, right? Especially when we have, war in the Middle East and stuff like that. And then there's also an aspect of correlation. And so with elite scalping, there's more to it than meets the eye. It's a little bit of everything, but it's mostly probability and assessment, thinking of what could be, not chasing what is.
Awesome. We'll put the link below. People can check it out. They can make their own mind about elite scalping, the program we're running together. I mean, it's a good program. People are getting results really fast from it, which is kind of cool to see. There's a lot of stuff you go into this. To go on live sessions with them, trade like twice a week with them on live sessions, which is kind of helping them get results faster, I believe. They can see how this works out below. We'll put the link. I appreciate your time here, Jean-Francois, as always. It's been good to catch up. Good to see how you're trading, of course. And I appreciate the work you do for the trading community, of course.
Sure, no, anytime. Tuesdays and Thursdays, I'm there with the Desire to Trade group, and then the rest of the week, I'm doing my own stuff. But it's the same every day. It's the same bread and butter trades, plus or minus a few other activities I have going on the side. But this methodology delivers a deposit to your bank. It's cash flow. It's up to discipline and perseverance. In the beginning, I used to get beat up by this all the time. The fear of losing that 4% is forever present. It's always there. But you become a better trader. You make fewer mistakes. And the mistakes you do make, you now have skills to fix. This averaging in and averaging out. And so it's this overcoming the fear by test driving the scenarios. Try this, try that. experience poor judgment and do so in the demo account. That's the only way to learn.
You always run in 2 hours a day maximum. Do you never trade more than like 2 hours per day? So that's a good benefit.
I don't click my mouse for more than 2 hours, but sometimes the trades are open for more than that. It's planning for that next move. The current move should end within a couple hours, and that next move is next. So this is the part we just don't know what we don't know. I can only go by previous averages, previous experience, and that's where the fun is. Not expecting too much.
For sure. Hope you guys like this video. Put your comments in the comment section below. I would love to do another video with Jean-Francois here, answer your questions if you have any questions about this. And we'll definitely be back to cover these questions in the future.
All right. Enjoy yourselves. Trade small, everybody.